Hello and welcome to your weekly GoNoGo Show here, calling in from Chicago, Illinois at the Student Managed Investment Fund Consortium. Alex, I have to say, compared to New York, Chicago is perhaps the cleanest urban area I have been in a long time. But 400 students, lots of professors, all of them run a portfolio for their schools, and really great conversations. Super smart next generation coming up, and hopefully they'll all be familiar with GoNoGo charts by the end of the week. Alex Cole, my dear friend, how are you doing today? How's life in New York City? Have you dried out yet?
Nice. Yeah, it was hot this week, and the temperature's broken a little bit. So I think leaves have started to fall. I think we're heading into to fall proper. So
Nice. Speaking of things falling, how about the U.S. equity markets?
you're
I
always
can't
very
make
good
jokes
at
like that. Sorry about that. But let's start from our cross-asset heat map as we do each week with you all. Thank you for watching this show, and hopefully some of these concepts are really ringing true for you, which is the idea of building a robust process, having the weight of the evidence, but keeping your visuals simple and really just following what the market tells us, reacting responsibly to those moves. So Alex, run us down from the top. How are we looking this week?
Yeah, well, as you said, things. You always make very good jokes at the beginning of these, so I'm sure that's a pleasure for the people watching. But yeah, markets fell a little bit again this week. Earlier in the week, we saw a really strong down day, which we've tried to rally from yesterday and today. We're trying to close towards the highs, but you can see the equity markets in a strong no-go trend. So yes, perhaps a little bit of relief from that counter trend correction arrow, but in a strong no-go trend. That's that top panel if we're talking about equity markets. Treasury bond prices, I mean, that is one long stretch of purple no-go bars. So strong downtrend in Treasury bond prices, of course, which are inversely moving to yields. And then if the one big change really this week has been commodities. This is the U.S. commodity index, and that has fallen out of a go trend and into no-go bars. And we'll have a look probably at some oil charts that have moved quite drastically this week. And then the lower panel is the dollar, still performing admirably in strong blue go bars down in the bottom panel.
Absolutely. I have to say the tendency for human beings to want to spot the turning points. I fall victim to this as well. And certainly from technical analysis, we can see important levels of support or resistance. A lot of conversation about S&P 500 holding that 4,200 level. And for those who are looking to jump into no-go trends on the belief that things are turning around, we discussed a lot in Las Vegas last week at the FX Evolution Conference, the idea of finding that confirmation. Certainly it's important to prepare yourself for multiple outcomes. But I think David Keller has said this best. Investors often forget that markets can move in three directions, right? We can move to the downside, we can be trending upward, or we can be in sloppy range-bound messes much longer than most of us anticipate.
Yeah.
I've read a lot this week and talked to others who are feeling that the bond market is oversold, that there's enough of a washout to start looking for opportunities. And if that's you, that's great. We're not here to tell you what your time frame or your objectives should be, but rather to just think about what evidence you're going to need to confirm that that view is correct. And if it's not, what are your risk parameters to help you get out? So we do have clearly defined risk levels at the S&P 500, and it's been an interesting couple of days to see market participants really bouncing around off of those that confluence of potential support here at 4,200. But Alex, let's dive in just to the GoNoGo chart of the S&P. Let's take a look at some of that price action, take a look at a couple different time frames, just to really help everybody get some context for where we're at.
Yeah, and this is what you're talking about here. We do have that natural level of support coming in at around 4,200 on the S&P. But when we look at this chart, we know the weight of the evidence is saying that we're in a no-go trend. The momentum oscillator is clearly below zero. We've had a lot of strong volume on this move down. So that's market participating in the no-go trend, and we're not yet testing the zero line from below. So from a go no-go perspective, no-go trend and negative momentum tells us what we need to know in terms of where we are going to position ourselves over the next few weeks at least. And we can bump this out to a weekly chart and get a sense of what this looks like. And this is concerning. For the first time in a long time, we have had negative momentum on the weekly chart as well. So a breakdown through that supportive zero line as the trend has weakened. And you can see that this is a new lower low. So we've got weaker aqua bars and we've got a break of support at the zero line on the oscillator. So a little bit of a concern even for the longer trend as well.
You know, I did a market review with Fineco Bank in Milan. I think that was Monday morning. Feels like forever ago. But just comparing U.S. equity indices to some of our European counterparts, and that broad topping and now entry into no-go conditions on a weekly basis for certainly suggests that the damage done here in the U.S. over the last month of trading is less severe, right? We're seeing a very sharp pullback within an otherwise still holding upward go trend. And that's why we built sensitivity into the model. So we have strong form and weak form of those go trends. Looking to that oscillator, Alex, I think is really the telltale sign that now we're seeing negative momentum, a real divergent bearish threat to the long-term trend of the equity index. Would you mind jumping into perhaps a 65-minute bar or a 39-minute bar just to see what the last couple of days intraday trading has been looking like on this shorter time frame?
Absolutely, and you can see it here. We've got no-go bars on this shorter time frame chart, but some positive signs over the last few hours. So, you know, you've really got to take into context these different time frames.
Absolutely. All right. Well, let's take a look at the chart of the 10-year yield here in the U.S. The interest rate discussion driving a lot of activity for investors on the institutional side and the retail side as well. Just thinking about that move in interest rates, breaking above upside resistance, potentially a next target level for the 10-year at around 5.34. 534 is a long way away, but there's not a lot of resistance in between where we're at and where we're potentially headed, which would certainly be a massive headwind if we move there very quickly. A lot of commentary just in the last 48 hours around markets receiving some perhaps maybe welcome news in the inflation narrative. Some of the data coming in a little softer than what was expected. I think what we might be seeing here, Alex, is a lot of folks anticipating, right? And I won't tell the falling knife joke right now, but anticipating the turnaround and looking for the opportunity to get in at the absolute low. That's not our game as trend followers, but talk to us a little bit about this trend in the 10-year yield here for the U.S. Treasuries.
I think to your point, if people are looking for this to fall back and provide that perhaps low entry for S&P or for other markets, you are predicting at that point, right? So right now we know the go trend is in place. We know the go trend is strong. We know momentum is positive. We've seen the oscillator come out of overbought levels a few times over these last few weeks. And these are definitely valuable signs of potential exhaustion points. As you can see earlier in the chart, when we have these, we have short-term pullbacks. Certainly doesn't mean the trend is over, which is why they aren't reversal signals for us. They're counter-trend correction icons. But you also know as a technician that heavy, really strong momentum can sometimes just be a sign of strength, and we can blow right through those levels. So you can see that the last two or three of these did nothing really to halt this trend in its tracks. And we've got another one now, so we'll see whether or not we get any kind of short-term pullback. But we're on the face of it, the GoNoGo charts here says strong trend on the daily basis with momentum still in positive territory.
Absolutely. Let's bounce that out to a weekly view as well. This breakout has been observable now for multiple weeks, and I think we've talked for a long time about the level at which interest rates are at is not necessarily the issue. Higher for longer is something that the markets can get comfortable with, but the rate of change and the acceleration to the upside for rates certainly can spook equity markets and risk on investors at large. So here we see that pretty solid year-long basing or chopping around sideways move before that breakout. And Alex, if you could just pull back more of the history, we could see a little bit more about where those next levels might be at.
Yeah, I mean, you have to go way back.
Right.
We're talking about. We would remember how we've been talking about this decade-long, 4-decade-long trend line. And if we really were going to look at the quarterly chart that we used to look at a lot, but we've gone way above that trend line, obviously, and now we're challenging these highs. Like you said, a little bit of a way to go, but we're talking back to 2007 here,
Correct.
about early summer. So this is a strong move in interest rates. And if I was to just pull that back to look at more recent data and that horizontal resistance line that we had here on the chart, this has been the third week in a row now where we've closed above those levels. We're going to watch the oscillator as we always do. If the oscillator comes back out of the overbought levels, we'll get a counter trend correction arrow, which might suggest some pause, but we'd certainly then be at a higher high, and then we'd look to see if the TNX finds some support then at the prior high that we've been just breaking above.
Yeah, really helpful exercise. A lot of technicians talk about is, cover up the ticker symbol. If this was a semiconductor company or an oil company a couple of weeks ago, this would be something you'd want to own, right? This is a trend you'd want to participate in. And so if we feel that way about the equities we invest in the standpoint that trends continue, then certainly this would be something I wouldn't want to jump in front of, right, and be a bond buyer right here.
Exactly.
Let's move on to chart of the U.S. dollar. Here at GoNoGo Charts, we use the Invesco ETF, ticker symbol UUP, get a sense of the volume activity as well. Starting from the weekly chart here, Alex, what an incredible rally over the last several months, beginning this summer. What are we seeing right now in terms of trend continuation?
Well, it doesn't seem long ago that we were looking at this such a clear horizontal level and wondering whether or not we'd break through it. And we just broke through it and we just took off. It's been about 6 or 7 weeks, maybe even 2 months, as you said, of just a strong movement higher. Now, the obvious thing on this chart is the prior high.
Little car accident outside your house there, Alex?
I think just some, end of the day, frustrated drivers.
Somebody who was looking at that TNX chart and watching their portfolio honking away.
But yeah, we're looking at this obvious September-October high here from last year as the most likely point of resistance. But we're still a little bit of a way from that. We do have overbought momentum coming out of those extremes. We'll see if that causes any kind of pullback. But we've really been able to just go higher almost every week, a higher close for 2 months, as you said. And if you look at it on the daily, you can see how sort of remarkable that run has been. Very few pullbacks. We had an opportunity here to spot trend continuation where the oscillator found support at zero, and we got a nice go trend continuation icon, but really just racing away. And we're going to look at the daily now to see what happens at the zero line and make sure that we find support.
Certainly. And as we approach the resistance area on this dollar index proxy, it would be perfectly acceptable to digest some of these gains for the US dollar to correct from here. But from a GoNoGo perspective, right, we want to see the weight of the evidence. Look at that zero line on the GoNoGo oscillator as an area of support, and see if we do see trend conditions change for. All right, moving on from the U.S. dollar, let's take a look at oil. Speaking of things that have reversed their trend a little bit here.
Yes, this is an interesting chart. And what's interesting, we'll probably see, perhaps we can pull up a couple of single securities later, but this happened a little earlier in some of the single securities. They're actually now in no-go trend. So a big day yesterday, gap lower for USO, coinciding with the inability of the oscillator to find support at the zero line and really heavy volume. So a lot of market participation on this sharp move lower. So definitely some change here in the oil markets.
So let's just talk about that from a process standpoint, right? We're using the composite tools here. We're in a weak form go trend, right? 3 days ago. We're building up the squeeze. We've seen the oscillator come to that zero line, volume dried up, and we've been building a squeeze. For Alex and I, and for users of GoNoGo charts on the institutional side, that's the moment to really be paying attention. Maybe you even shorten up your time frame for what you're looking for the break of the GoNoGo squeeze. When we see that volatility break, it's the direction of the break that matters most. And here we were in a go trend, all else being equal, finding support at the zero line throughout that upward move for US oil. When we break out of the squeeze to the downside, volume picked up. And of course, price action accelerated to the downside as well. So those GoNoGo squeeze indicators are really important. They can give us either of two conditions: either a trend continuation condition, right, where we've had a strong move and the tug of war between buyers and sellers debating whether or not that security can move higher. It's the resolution or the break of the GoNoGo squeeze that gives us all the information. Had the squeeze broken to the upside, we'd certainly expect to see price action moving that direction as well. So from a risk management perspective, we are currently in go fish bars, telling us there's still some uncertainty based on the trend following model. But trend following, moving averages, everything that you've learned about that space is that those are lagging indicators. So if you have been involved in the oil trade and looking to capture some of those gains in your portfolio, then certainly the break to the downside of the GoNoGo oscillator, the change of trend color, those would certainly be risk signals to exit some of those positions or at least lighten up. That's the way that we think about using some of these tools in GoNoGo charts.
Yeah,
Alex, sorry, go ahead, please.
No, I was just going to say we're looking at one of the securities in that sector, in the energy sector, and this is a very good example of what you were talking about. We've got these multiple max squeezes throughout the go trend that were broken to the upside and give you those go trend continuations. The latest one here led to a nice pop higher before coming back to test that zero line again and failing quickly at it. And you can see that this failure to hold the zero line happened as we were still in this go trend. Then we have the amber bars. We're actually now in a no-go for Valero, which is one of the securities, obviously, that is in the oil exploration and production subsector. So slightly ahead, perhaps, of the larger sector, or ahead of the oil ETF itself. But it's a nice example of these squeezes building and being broken.
No, that's a really good illustration. Thanks for bringing that in. Let's stick with commodities for a second. Let's just pull up a chart of gold. And we've talked to a lot of folks who are really expecting, right, anticipating that gold would be the flight to safety move in the rising rate environment. But certainly we've seen that correlation or lack of anti-correlation between the US dollar and the chart of gold really holding true this year. And so, Alex, we're in strong no-go trend conditions, extreme oversold on the oscillator, just pulling back a little bit. Talk to us a little bit about what you'd see for this trend.
Yeah, I mean, just cratering to a new low. I mean, this was a very quick move. We've had about 6 strong purple bars in a row, broken below what looked like it could have been fairly significant support. And I think that's to go to your point earlier about, if you're looking for something to happen, like some people are at the moment, looking at those levels of the S&P to provide that support for entry, then just make sure you're using some reason to get in if that's what you're looking for. So like we could have been watching this oil chart and expecting support at these levels, but you've got to only then get in or take advantage of what you think might happen if you do see signs of it happening. And in this case, there would have been no reason to get in. If you'd have looked at this on an hourly chart, we wouldn't have had any go signals, and we just went straight through support. So if you were sitting there expecting support and holding on to that thesis, we've talked about having a thesis and how really you just want to look at the charts. We've talked about that so many times. But if you had a thesis here, you'd have to be ready to admit you're wrong. And the market told us that there was no real reason to be buying gold. Even though it looked like there might be some strong support here. We broke down through resistance at the zero line. We broke back down into negative territory on heavy volume, broke out of a max squeeze, price gapped lower, closed below where we would have expected support. And then, for a fact that thesis was wrong. Why? You know me, Tyler, I've always been one to say I don't
The truth is, we often know the why long after the trade is over, and I think
You usually find out why.
we actually find out why. Correct. Just a week before Sam Bankman-Fried and the exchange blew up, uh, the smartest guys in the room, the private equity investors, are ready to give him $1 billion and a
Hmm.
brand new valuation and a new lease on life. So uh, those are the smartest guys in the room. And even then, sometimes they don't know all that is going on behind the scenes. So if you need a why, read murder mysteries. Don't leave the stock market alone. We often find out the why after the fact, but we need to make sure that we're managing our risk in real time.
And like murder mysteries, I have to say, over the summer vacation, I actually read one. My mom said, "Oh, read this; it's a good read."
Yeah.
But like murder mysteries, the clues were often there, right? So
Yeah.
you could have picked up on it, but it's hard to do in real time. And so, for example, if you're looking at gold and thinking, "Oh, why did I think there was support there?" As soon as that oscillator broke the zero line into negative territory, that was a clue that you should have picked up on, that perhaps what you were expecting to happen wasn't going to happen. So you find out why after the fact, and usually you can see the clues
Mhm.
leading up to whatever happens. But anyway, that's
I love it. It's a perfect analogy. Maybe you and I will write some true crime novels together later in life, Alex. All right. Moving away from true crime, let's get back to U.S. equity markets. Right now we're looking at all-time new highs on a relative basis between the Nasdaq and the Russell 3000, excuse me. And when we start to compare different indices, we have to realize that they're not representative of the whole stock market. So the S&P 500 is really just a momentum play, right? They sort out and remove companies that don't stand the test of time, and so it's a cap weighted index. We're certainly seeing large cap growth equities outperforming the average stock in the market, and had a great conversation as part of Fill the Gap podcast, the official podcast of the CMT Association, just last week, talking about value line geometric index and some of these other signals, showing us just how weak breadth is. But for our purposes, Alex, let's get under the hood using our sector rel map. Let's take a
yep.
look at the 11 spider sector ETFs that represent the S&P 500. Let's start to see some of this rotation that's been chopping around. Certainly, what draws my eye immediately was that earlier last month, we saw utilities strike an outperformance week against the index. That, in and of itself, when we think about very defensive sectors
Mhm.
outperforming the index, gives us some idea around positioning amongst investors, right? If money is flowing into utilities and consumer staples, that's a very defensive signal. And potentially something to look at for risk off. That has not persisted. So perhaps investors have realized that maybe there is something more constructive happening under the hood. Alex, talk to us about what you're seeing on this rel map.
Yeah, and it's interesting because last week we were noting uh, healthcare coming into outperformance. We were noting that communications and energy were trying to hold on to their outperformance. Well, not much has changed. There's a little bit more uncertainty, perhaps. There was a lot of uncertainty in the healthcare index, but it's come back
Hmm.
into outperformance with this go trend here in Aquabar.
Hmm.
And we're still seeing communications hanging on to their outperformance. And energy, as we've seen, has uh, flipped to this amber go fish bar. So a lot remains to be seen here. Interesting that technologies come back in the top chart. So we'll keep an eye on that one. And even discretionary as well, showing some uncertainty. So could we be returning to those mega cap growth stocks if we have all three of these starting to outperform? That'll be interesting to watch next week.
Absolutely. And for everybody who's watching this, remember, relative outperformance just means that it is going down less than the S&P 500 when we look at these on an absolute basis. In fact, Alex, why don't we just pull up a chart of the XLK, which is outperforming this falling S&P 500. When we look at just a simple chart of the ETF, we can see that that is still in a no-go trend. But what technical analysis is so powerful in looking at these comparative charts, we can understand where leadership is coming from, and we can certainly position our portfolios. Let's say you have to have some equity exposure because of your mandate or because of your retirement objectives. You want to be in those sectors that are outperforming the benchmark
Yeah,
index, and therefore experiencing less of a drawdown than the broader market.
absolutely.
So there's the XLK on an absolute basis. Again, back to that sector rel map, we can see that it's outperforming the S&P 500. Now, Alex, let's look at healthcare for a second, but let's get inside of the XLV and look
Yeah.
at the industry groups therein, and where leadership is coming from in the healthcare space.
Yeah, and I
Now,
wrote about this in our note that goes out to our weekly subscribers this week. We're seeing some real outperformance driving that healthcare sector coming from healthcare providers. So that's there's been other sectors that have been performing well, some that have rolled over, some that haven't performed well for some time. But the
mhm.
one that seems to have come into a relative go trend and strengthened to paint strong blue go bars relative to the sector itself is the healthcare providers. So that's this third panel here, and you can then look inside that group for some security ideas.
Well, why don't we pull up a couple of individual names here towards the end of today's show? Start with the ticker symbol MOH.
Yeah, so Molina Healthcare, we're looking at that as a fairly well established go trend. And this just, I mean, it just speaks to your point, Tyler. You need to be invested in equities, given that healthcare has been outperforming now for a couple of weeks. You could be in a healthcare security while the rest of the S&P has rolled over. You know, you can see that relative alpha right there.
Mhm.
But an interesting chart because we are at an inflection point. We've had a higher high, and now we're hoping this is a higher low. You can see that this area acted as support. It was resistance, and it has become support. That's that concept of polarity we talk about a lot.
Mhm.
Oscillator riding the zero line as a go-no-go squeeze builds to its max. So it's going to be very interesting now to see if the oscillator finds support, rallies back into positive territory. If so, we'd look for price to perhaps mount an attack on these prior highs. Of course, if it crashes below zero, then that's more of a concern.
Absolutely. You know, we were looking through a number of futures charts earlier in the week. Cocoa, sugar, really strong trends on both an absolute and relative basis. And it just occurred to me that those makers of Ozempic, Novo Nordisk, and other healthcare companies also in really strong absolute and relative go trends. So maybe there's some correlation there in the American diet, just how much chocolate and sugar we keep eating. But the makers of diabetes medicine and weight loss solutions have certainly outperformed here for some time. Let's pull up Cigna Health Group (CI) as another opportunity for investors to perhaps wait out the storm.
Yeah, so this is an interesting one. Again, we talked about it earlier in the week. We are looking at this new return to a go trend. So has had a correction in the last couple of months, but returned to a go trend and then pulled back. Now, we like that situation when a new trend is identified and it pulls back. We then look for trend continuation. Well, we struggled a little bit over the last couple of days and actually painted a couple of amber bars, but we are still holding the zero line for support on the oscillator. So with this go trend trying again, we'll watch to see if support is found, if we can move back into positive territory. And if so, we'll get trend continuation. We could look for new highs in Cigna. What's interesting about Cigna, Tyler, is that if you look at it on a weekly basis, you may be looking at the start of something. So if you get the reason, again, this is that same thing. If we're thinking we want to get involved in healthcare, we see the long-term trend develop, let's look to the daily chart, but let's go into that position with a reason. So if that support is held by the oscillator at the zero line, if that we get go trend continuation, we may look to participate in this trend, which we see on the weekly chart is painting strong bars and is in its early days. And we're seeing again an attempt to find support at the zero line.
Absolutely. What a fantastic use of multiple time frame analysis, and you know, when we think about how a rising tide can lift all ships, if we are indeed seeing healthcare begin some outperformance of the S&P 500, then we would be looking to these industry groups that are going to provide those leaders. So whether you're a tactical asset allocator and you're just thinking about getting your sector and industry groups right, or you're looking at individual securities for trades, certainly to the long side, you want to do that top level analysis and get down to the industry group level to start looking for those opportunities. Similarly, when we find the sectors and industry groups that are outperforming, The individual securities therein that are deeply underperforming, you can rank those into your list of short ideas. So it works. It cuts both ways, right, Alex?
Absolutely. Couldn't have said it better.
Well, I've got a lot of learning to do with some of the smartest undergraduate and graduate students in the land, and looking forward to another day with them tomorrow. But from all of us at GoNoGo Charts, thank you so much for checking this out every week. We're going to be here with you. And if you have any questions for us, you can shoot us an email, info@gonogocharts.com. Even from the plane, we can answer those questions. So thanks so much. Until next week, take care of each other and trade them well.